Hello and welcome back to another episode of Fun Friday with a very special guest here, a friend and partner here, Steven Woodruff with Aspen Funds. How are you today, my friend?
Hey, Craig. Great. Doing well. Good to be with you. Excited to be on the show.
Absolutely. Yeah, no, we saw each other, of course, not too long ago,
Yeah,
and Dana Point. So, a
that's
long
right.
way from you living in the Northeast area to come down to
Yeah.
a West Coast event, but hopefully you found that to be productive. And we figured, you know what, it was time for us to sit down and have a conversation and do an episode together. So, very happy to have you on here. And you've got a very interesting and robust background from a career perspective. So, we'd love to have you just kind of give, the story of who you are, what you did before this. We'll dive into that, and then what you're doing now.
Yeah, great. Well, yeah, thanks for that. I started my career in finance. I was in finance for almost 20 years, a number of different roles. I started as an analyst and spent most of my time as a financial advisor. And I built a pretty large advisory practice. I had over $1 billion of assets under administration at the end, and I've exited that last year, 2023, pretty much when my daughter was born, and um, I still maintain kind of my certified financial planner designations, but I'm allowing my licenses to lapse. So I'm not a registered advisor anymore. Um, but yeah, that's kind of the background and what I do currently. I'm happy to talk about maybe why I made the transition or things I saw in the industry or what I wanted to accomplish. But ultimately, what I do now is I work with family offices. I work with a company called Aspen Funds out of Kansas City. They're very well known for their podcast called Invest Like a Billionaire. That's how I first became aware of them. I had started listening to their podcast for a number of years and met those guys subsequently. And but now I help them manage their family office relationships, investing in commercial real estate and oil and gas and private lending. So
Awesome.
that's what we.
Yeah, can you touch on some of the products you guys have? Because we've got so many people that we've actually kind of been sending over to Aspen, of course, with the great people there,
Yeah.
with Ben and Mike, obviously.
Mhm.
Bob is being the patriarch, of course, but would love to hear about some of the products just for some of the people who are listening to this to get a familiarity with what y'all do from an investment perspective.
Yeah, so the firm was started about 12 years ago, in the wake of the Great Recession. Coming out of that, there was a large, massive opportunity in residential mortgages. And so they were buying residential mortgages that were performing, but there was some sort of issue. And so they were getting them at a discount and creating a portfolio, a fund of those mortgages for investors to invest in directly. So we have a pretty long track record of private lending on the residential side. We believe that there's an incredible opportunity for private lending currently with the high interest rate environment that we're experiencing. And so we've expanded sort of that offering where we have that existing residential offering that we do um, commercial real estate lending as well. So safer down the capital stack than a traditional equity play. But because of the high interest rates, we're seeing almost equity-like returns in a little safer position. So it's another play that we like, and we think that opportunity will be available for quite a few years. Really, it's gonna, we believe, take some time for us to fully know what interest rates are going to do long term. And banks have really tightened up, and so there's just this window right now where private lending just has an opportunity to do very well. So that's a main pillar for us. We're also doing ground up industrial um, build outs. So think about like an Amazon warehouse, that type of industrial space. There's a lot of reshoring of jobs coming back to the United States. There are jobs moving from China into Mexico. We need distribution here in the United States. There's just much more demand than there has been historically, and companies are starting to hold higher inventories. They almost got wiped out during COVID with supply chain blocks and ports being blocked. And so we need warehouses, and we need distribution sites. And so we think that will be a play for easily the next 10 years. And so we're finding opportunities in that space to build some ground up new development. And then our third real pillar, I guess you could say, is in oil and gas. Again, this is another mega trend that we think will be very important for at least the next 10 years. It's an asset class that has been very beaten up. It's out of favor in the period of ESG investing. A lot of institutions are looking away from it. Endowments are not looking at it. And so we're buying assets at very attractive prices with high cash flow, and they're performing exceptionally well. And
Yeah,
so we're very, very excited about that play.
yeah, and oil and gas is very interesting as well because oil and gas has got massive write-offs that, you could take advantage of if you're a W-2 earner, not if you're just a real estate professional, right? With, bonus depreciation there, maybe
Yes.
offsetting some passive gains. So that is a very nice accretive strategy to an investor. So if you are looking to have a massive deduction, this is the gentleman for you to talk to right here. But you mentioned something really interesting, which is you obviously got to a point where you're extremely successful in the financial advising world. And
Yeah.
typically speaking, if you get there, it's very hard to get there. And most people don't leave if you made it to that level.
Yeah, that's
So
right.
similarly, I made a transition as well from my residential career. I know why I did it. I was looking at some reasons to get, okay, this is changing a bit. This could be, a little bit greater if I, joined with a firm like Lone Star and align myself there. But I'm curious to know, how and why you left from, running about $1 billion portfolio to, the alternative space, to the dark side.
Yeah. Yeah, it's a great question. And it's something that I calculated very carefully and I thought about for a long time before actually pulling the trigger and making the switch. And I knew I couldn't essentially go back if I did make the switch. I mean, I'm handing over and transitioning my clients to other advisors. You're starting over if I leave and come back. And so that wasn't going to be an option. It was sort of a burn the boats situation. I was fully committed. I'm not going to turn around. I'm not going to go back. I'm fully committed to trying something completely new, making an entirely new career change. And to your point, it does get much more comfortable. The first couple of years were the most brutal work I've ever had to do. Um, as a young 20-something-year-old, calling wealthy people and asking them if I can uh, review review their accounts with them. I've been hung up on so many times, and I
Yes.
and I was just relentless with I'm not going to give up back then. Yeah, 15 plus years ago, I'm just not going to give up. I'm just going to keep doing this, keep my head down, and it turns into something. And over a number of years, it becomes um, after you start to help with a lot of assets, then other people start to get referred to you. You do a great job with someone on a small piece. They give you a chance with something small, and you do a great job with that for years. And then you get like, hey, my wife has a rollover. Let's bring that in, and it just happens all of a sudden. This snowball turns into something so much bigger. And at the end, yeah, I mean, massive growth happened at the end. The last couple of years, people would sell their companies and get $100 million, and yeah, it's coming with me because I've helped them for the past 7 years on a much smaller amount. And so we started to see those things over time. And so you're right, it absolutely was a tough decision. I felt very comfortable. Um, yeah, I had record years at the end, which can be really hard to walk away from. But really, to your point earlier, why did I come to the dark side, the alternative asset space? I'll share this with you. My wealthiest clients, and I'm talking about people with, let's say, 50 million of assets into the billionaire range. They all got there. Now, they may have had a business, but it wasn't just maybe an exit from a business. They invested heavily in commercial real estate and in private equity. And they saw massive returns from that kind of fairly consistently year over year for a long period of time. And they created a massive amount of wealth. And so I would ask these people tons of questions. I would help them on a sliver of what they had, but their real money was tied up in businesses that they had acquired, or tied up in commercial properties. And I was a sponge. I knew there was something I could help them with, which was they wanted a piece that was in traditional equities or traditional bonds, or and a certain amount of cash that I could help them like earn some more basis points on their cash. But really, they had created their wealth in another way, and what they were doing seemed very logical to me. It made sense how they were able to create so much wealth. And so I realized early on that I was never going to be able to create this massive wealth that I was hoping that I could through a traditional W-2 job, saving in a 401k. That it was just never going to get me there. It would be totally fine, but there was something that I was consistently seeing other people do for decades that was something that I knew I wanted to do more. And so it was about 7 years ago. I started buying properties personally. Um, I started buying some vacation rentals. I started buying small multifamilies, and I kept kind of growing that on the side while I was kind of building my own portfolio in real estate while I was running an advisory business. And it just became larger and larger. My wife started helping me out, and it was a great experience. I mean, I'm very passionate about real estate. It's an incredibly powerful tool, and I started to create more wealth from real estate than I was from saving in my, you know, certainly, maxing out the 401k, and I'm getting stock options, and I'm getting bonuses, and I'm creating more wealth through real estate passively. Not passively. I was pretty active, fairly active at that time. But I started to create a lot more wealth in real estate, and it became evident that I can really do this. And I started really crunching numbers, and I'm seeing the returns I'm getting in real estate, and they were like massively more than I was getting in my stock portfolios. But I'll give you this one example as well, because I these numbers blew me away when I was running them, and they stuck with me forever. And it was part of my decision to make the switch. Is that I looked at, if I take, or if any accredited investor really, if an accredited investor, so someone who has $1 million net worth, not including the equity in their primary residence, if they invest that $1 million in the S&P 500, historically they would average about 10% if dividends are reinvested over a long period of time, 40-year time frame. So what that turns into, $1 million over 40 years at 10%, it turns into about $40 million. So a decent number. If they get a little bit higher return, like we can see in commercial real estate, like, Craig, is it unrealistic to get a 15% return in commercial real estate as an LP? Pretty reasonable, right?
You can certainly average that. I mean, some vintages
Yeah,
might
yeah.
be an 8%, but you might get years where it's a 40 or 30 where you're really doubling your money, right? We saw that during
Yeah,
COVID.
right. So 15 is pretty reasonable over a long period of time. And so I
Especially if
look
you
at
work with
that.
Lone Star or Aspen.
Right, that's right. So at 15, it goes from 40 million, not to 60, it goes to 260 million. 1 million becomes 260 million in the same 40-year time frame. And even potentially 20% is possible, and that turns into $1.5 billion. 1 million turns into 1.5 billion over the course of 40 years at a 20% return. And so what became very evident, I was doing this math like 10 years ago, and I'm saying, if I get a little higher return over a long period of time, it massively explodes my wealth. It's not even close. I couldn't possibly earn enough money in a W-2 job to match the power of getting a couple percent more over a very long period of time. And so when I could afford to make the switch, I've built up enough wealth. I have it in my rental properties. They're doing fairly well. I didn't want to wait forever until I was 100% fully secure. I wanted to do it sooner. I wanted more time where I'm focused on my investments and I'm focused on growing my wealth. And I wanted to see, I wanted to participate in a very long period of slight outperformance. And I knew that commercial real estate, I knew that alternative investments, I knew that private equity into companies was the way that I wanted to get there. I wasn't going to see outperformance in traditional stocks. I was going to get market-like returns, which just wasn't going to uh, provide me with the results that I was going to be happy with, that I was looking for. And so that's why I ultimately made the switch. That really was the key.
Right. So that's the catalyst there. And you mentioned,
Yeah,
with regard to a 15 IRR versus stocks and bonds. But naturally, when people hear higher returns, they're thinking obviously the contrary, which is the risk profile associated.
that's yeah.
So when you look through deals, when you look through opportunities, when you're buying your deals, how do you kind of assess risks? And can you also maybe touch on maybe potential misnomers or truth? Is commercial real estate, is real estate generally speaking with a higher return riskier than investing in stocks and bonds or, things of that nature?
Yeah, I mean, it's such a good question because you're right. That's where everyone's mind goes to. If I'm getting a higher return, it must be a different risk. It's a completely different risk profile that comes with commercial real estate. Well, I like it for a lot of reasons. I don't believe in general the asset class is more risky. I believe it's less risky. Now you can do it in very risky ways. You can have ultra high leverage potentially. Right now you probably can't, but in certain periods you can get very high,
Yeah.
incredibly high leverage. You can absolutely find there are risky deals out there. I mean, I think, for example, and no one knew this was going to happen, but when COVID happened, office space became worth very significantly less. And there are certain vintages, if you have some older office properties, it's probably not worth nearly what you would have paid for it 5 years ago. It's probably worth very significantly less. And so, yeah, there is a possibility with risk that is there. So I don't want to say that that's not there, but in general, it's much more secure. It's significantly less volatile. There are some trade-offs that you get with investing in real estate compared to traditional stocks. That the main one that always comes to my mind is liquidity. So if you're buying an expensive building, you can't just the next day pull your money right back out, right? It's typically a long-term play, at least several years. It's typically not a put my money in and get access to it right away. And so you have to be comfortable giving up liquidity, but the benefits can be pretty tremendous. Tax benefits, stability, higher returns, the power that leverage plays on your return when done smartly is enormous. And so, yeah, generally speaking, it's less risky, less volatile than stocks. Every asset class has their own risk profile, and I would also say that investors should keep in mind that real estate is a very local thing, and so one market can be very incredibly different than another market, and so you want to be careful there. You don't want to just say I invest in self storage and think that means the same thing everywhere. It doesn't. It's yeah, you want to really understand your specific market, but yeah, it's also what I love about it. It's there's a lot of opportunity to provide outperformance just by being just thinking carefully about your decisions and understanding the reason why this asset might outperform another asset or this market might outperform another market.
Yeah, and real estate is so regional, and I'm really happy you mentioned that. It's regional, it's politically different in any market you go into, inherently
Yes.
blue states, red states, purple states, development, CC&Rs, things of that nature. If you go to certain areas, there's zero transaction volume. You go to some other areas, there's a lot more. If you go to,
Yes.
the Northeast, some pockets, we had Axel on the show, and he was kind of explaining how there's zero supply coming online. Well, even though it's a blue
That's
state,
right.
if you got zero supply coming on, what does that do? That means your properties inherently have a lot of value, and investing in a 70s deal or 60 deals there is a lot different than investing in a 60s or 70s deal in Texas.
Yeah.
If you go to Texas, obviously it's really pro growth. It's very friendly to own real estate, like Florida, but of course you get more development. So to your point, there are good deals in any market. You just got to sift through them and find them and put your dollars into good opportunities. To your point
Yeah.
there. And then you also mentioned another thing there, which I love, which is, the fluidity and the liquidity, or the liquidity nature of stocks and bonds. So that probably drives out
Yes.
some of the alpha. But with that liquidity nature, it also creates the market to be a lot more efficient. People who trade stocks all day long, when I hear people are day trading, I almost kind of laugh, because it is legitimately the hardest thing in the world to do is to day trade, in my opinion, and to do stocks. I think real estate is a lot more down the fairway, a lot more simple. But I think so often I hear people touch on, doing that. Can you maybe mention, some stuff that you've heard there, or just the differences between the two in that regard with the efficiencies in the marketplace? Because it's a lot easier to create alpha in real estate, in my opinion, when you're buying from mom and
Yeah,
pops,
agreed.
you're buying from distressed people, than you are in the stock market, typically speaking, unless you're getting a little inside trade, or if you work for Congress.
Yeah, it's such a good point, Craig. The inefficient nature of real estate, when I say inefficient, it's that a lot of times you need to find the deal. A lot of times in commercial real estate, they're off market deals. It's not the MLS, it's not realtor.com, where everyone sees the same deal and looks at it the exact same way. Um, Comps are fewer and further between. Understanding the best use of a property can be a little bit more complex, or where do you spend your renovation dollars? You have to see the value of what it could become a lot of times and create the deal yourself. And I would also say there are opportunities for creative financing that maybe are not available. So there's a lot of pieces to this on how you can create a deal, and two people can look at the same property and see a value of it very differently. Even experienced people, they can see an opportunity differently. They can say, I would do XYZ, and that would create, this much more value than if I just run it the way it is. And so, yeah, that is very exciting about it, because when you're with an experienced team who knows how to look at a property and knows how to extract value from it, maybe better than other groups, there really is an upside for the investors, and that's pretty cool to be a part of. In terms of, you're right, well, I'll just use the S&P 500 though as the benchmark that I'm referring to, but it's incredibly difficult. So if you invest in that, it's super easy in terms of you get a broad basket. You can invest with a very small dollar amount. You have liquidity in terms of you can get your money out tomorrow if you want it, and have cash to spend, but you don't know what you're going to receive at any given. Like it fluctuates so wildly because of the liquidity. And in order to provide outperformance to the market in general, you have to take significantly more risk. You have to make very concentrated bets and take a lot more risk than if you were to own the broader basket. And so it is very difficult to outperform. Very few fund managers do it consistently over a long period of time. And so, yeah, to your point, there's trade-offs for sure, but it's very difficult to get outperformance in the traditional public markets.
Without a doubt. Well, and I appreciate you touching that, because it is interesting. Sometimes we hear these returns and it's hard to believe for those who are more the traditional route. There's nothing
Sure.
wrong with one or the other. It's just, and also it's kind of scary to identify a good sponsor and someone to work with. Not
Yeah,
everyone
that's right.
has a relationship, a long-standing one with, a sponsor, or, something like Aspen or something like Lone Star, the household names. Not everyone has that. And then, of course, what we're also gonna be dealing with right now are the people who are getting burnt in this point of the cycle, which is
Sure.
unfortunate, but that's how you create true alpha on, the investing and buying side this way around. And it is crazy. There obviously are a lot of dollars being evaporated right now, But it goes back to, I guess being smart and sound with fundamentals when you do make the acquisitions, and maybe not always rolling from deal to deal to deal if you don't think it makes sense. So, and also there's different profiles and risk tolerances within opportunities within commercial real estate. So for instance, you could get a little bit more risky with, throwing on a pref or a mez stack into an opportunity, but that might be in, position above your common equity there. And that might look different. You could get into a bridge or floating rate debt deal where if you float down, you might look like a hero. But if you, had a rate cap or you've got an extended deal, your equity could have evaporated. Or, you could be in a bridge where it's a 2-year deal. It's a little bit risky. It's pretty levered. That could have its downside consequences, which is what we're seeing in real time right now. Or you can invest in opportunities where you throw on, 5 to 10 year or somewhere in between agency debt, where maybe you're not, hitting the highest home run, or maybe you have a very hefty prepayment penalty to exit, but at the same time, your downside is mitigated. So I like to be, to your point there, a little bit higher than a stock market return with our deals, which typically have a 5 to 7 year debt term on them.
Yeah.
But don't want to be the riskiest, obviously, with the spectrum of, really threading the needle with, shorter term debt notes that aren't fixed.
Yeah. Yeah. That's really solid advice. And that's where most investors who are getting hurt did get hurt over the past couple of years. No one expected these interest rates to jump as fast as they did.
No, a 40-year
It was a
unprecedented
massive
hike. Yeah.
move. Yeah, I mean, it was massive. And so if you were invested in floating rate debt, chances are you're really paying for it. And that is a tough position to be in. We don't know when interest rates will come down, if they will come down. We're certainly eagerly waiting and seeing what's going to happen there, but we're looking for deals that pencil out and make sense right now. We're getting typically fixed rate debt, at least fixed for a period. And so, yeah, it does lower our risk significantly. If it's working right now and we're locking in fixed debt, we're probably going to be in a good spot. And it'll be a nice bonus if they eventually do come down.
Right. So what were some of the insights going back to, working with your ultra high net worth clients?
Mm-hmm.
What were some of the insights that they kind of lent to you pertaining to just good thoughts and advice that really made you felt compelled to switch over? Because my dad has told me about one of his clients, funny enough, he's this Morgan Stanley guy who, interestingly enough, is a self-storage guru. He's got tons of self-storage stuff, and then from some of that cash flow, he's got an annual contribution that goes into Morgan Stanley stuff. And now I think they're also looking into, using private banking from Morgan Stanley there just as a lender and doing investment banking there, which is obviously a nice piece for him. But be curious to know what some of your, top clients, investors had to say if they were in the alternative space, because I think that might be really nice for some of the LPs that are listening to the show, and maybe some of the sponsors listening here, how to kind of guide, a thought process to talk to the people there.
Yeah, so the ultra wealthy clients that I had, they created it through concentration in a specific area that they knew. And so that's not how they always maintain it. They generally diversify out to lower risk. But generally speaking, they find something that they really like, and they're all in essentially for at least a long period of time. Then they start looking at diversifying into other things that they think are safer and that they're comfortable with. And so, like, I'm thinking of someone in particular in private equity that he did an incredible job in financial companies, acquiring financial companies. But he was diversifying into more commercial real estate to find something more consistent that he didn't have to be super involved in. And so I don't know if this answers your question exactly, but yeah, they were kind of focused on the wealth creation side, of very focused on one thing that they were excellent at. But at some point they wanted to preserve what they had. And so they didn't want to keep up that pace and that focus and that risk. So they began to diversify out.
I see. That makes sense. And then one thing I find very interesting is the conversation of when we have a potential prospect who's looking to invest in Lone Star. And I've actually had this as well with my residential real estate career, which was I had to run this by my financial advisor.
Hmm.
So I have a
Yeah.
reason as to what's going to go on, as to why every single time I hear that, I'm already expecting a no. But I'm very
Yeah.
curious to know why that is the case and where you've been before, and if you could speak to that.
Yeah. So yeah, it's such a good question, and it's kind of a complicated answer. And the reason I say that is, for one, they are financially tied towards, if you move assets out of your brokerage account, they earn less money. So there is a financial incentive for assets to be accumulated and maintained within that broker dealer. Number two, they are not they're incredibly unlikely to recommend an asset. Their employer won't back them up on that typically. If the kind of the broker dealer or the RIA hasn't pre-approved that asset. And if they're going to take the due diligence to go through that process, um, it's just very timely. It's not a good use of funds for the broker dealer typically. And so it just makes them unlikely if they say, yeah, go ahead and do it, but their employer hasn't said that's sort of a pre-approved asset. They can find themselves in a situation where if the investment doesn't work out the way that the investor had hoped, and they said, well, my financial advisor signed off on this. He said it was sounded good and suggested that I, thought it was fine that I go with it. They won't necessarily be supported in court by um, their employer who's trying to preserve their name, and so there's nothing but downside. There's no upside for them to recommend it, and so it's very unlikely that they will. They may just say, hey, I'm just not comfortable reviewing that, or they may actually sort of sell away from it and say, if you like that, hey, I had this other thing that's has a similar profile. So they may suggest an alternative, but they're unlikely, incredibly unlikely, to spend a lot of time really pouring into the underwriting model, like really looking at the details and actually understanding the investment that their investor brings them that's with another third party. They're more likely to try to shoot down one way or another.
Well, also too on their end, it doesn't really incentivize from a time perspective. Obviously, everyone's busy. They're not going to be underwriting a deal, but it just seems as if
Yeah,
every single time that it happens, I'm already okay, great. I'm going to follow up with this person because, that's what a good salesperson does or a good,
mm-hmm.
investment advisor does, but I already know it's
Sure.
going to be a no. But it's just kind of funny, routinely, I already know what the answer is going to be before, and that's usually the end of the conversation there. And that's just kind of part of the business, of course, but appreciate your
Sure.
insights as to what that looks like, because I'm sure if you're a sponsor, this is not the first time you've heard that, and I'm sure you're chuckling if you're on that end. And if you're an investor that has that happen, if you actually want to invest in the deal, just do it and don't run it by them.
Yeah, I think we just know what their guidance is probably going to be already. So if you really want to, I think it's fine to keep them in the loop with. I think you should have a relationship with your advisor where you can tell them, hey, I'm really interested in doing this. I'm planning to do this. But just know what their perspective probably is going to be in advance. They're probably not going to be for it. They're not incentivized to do it, and there is actual downside if they recommend it. So they're unlikely to. But so you should just have that understanding before you bring it up. But if you have a good relationship with your advisor, then, and if I had a good relationship with my clients and they said, I want to do this, if we kind of just model it into their plan that they have these assets and here's what they expect from it. And when we update the plan, I just say, hey, how's that investment doing? What's the current value of it? Um,
Yeah.
and that's it.
Yeah, how much do you think the investment world, the financial advising world is changing? Obviously, when you get to the ultra high end net worth clients, it's obviously a different ballgame, but that's
Mhm.
few and far between for the vast amount of people who are investing in stocks, bonds, things of that nature, right? So I'm very interested as to, how much the Robinhoods, the E-Trades of the world
Yeah,
is actually affecting the financial advising business. Because if you're young getting into it, I actually don't think it's never been a worse time to get in that business. I feel as
sure.
if it's more generational people passing it down, or you kind of have to
Yeah.
get with the book currently. But I don't really see there being a crack or a hole for someone to fill with all the new ways for people to invest and park their money.
Yeah, I mean, the robo advisors are getting better and better, both from a management of investments, but also just providing financial guidance. Um, in the very affluent areas, it's different. There's a lot more complexities, and they want the personal touch, and they want to know that you really understand. That they don't just throw it in a robo advisor and let it go. And so, yeah, I think you're right. I think it's a very difficult time to get started. Um, I mean, my career, I was very focused on a very wealthy client. And so their needs were more complex, and that gave us opportunity to add value above and beyond just rebalancing a portfolio. So yeah, but I think you're right. There's a lot of new low cost competition that's coming online, and it's definitely having an impact for the smaller investors. And I think what you see at a lot of um, advisory firms is that they'll have like $1 million minimum essentially to work with an advisor for a lot of them. To have a dedicated relationship, it's like $1 million typically. So it's not really the average person.
Yeah, without a doubt. It's basically an accredited investor allows them to have a
Yeah,
relationship, and that's, dollars and assets to them to get things going, which makes sense to make it
yeah, that's right.
deemable and worth their time. And I
Yep.
also have a follow-up question on that end while we're on the financial advising worlds, which is the Roth IRA and the 401k route. So the biggest
Mhm.
argument that I have with my dad is the fact that I don't put enough money in my 401k, my Roth IRA, or in my Roth IRA, excuse me. So I'd be curious to know what your perspective is on that, coming from the financial side of things. Obviously, owning a bunch of real estate, as you alluded to start the show.
Yeah.
Be curious to know your perspective on that matter there. Is it a good investment route? Would you recommend it? Knowing you know right now, do you feel as if it's antiquated? Be curious to know your thoughts.
Yeah. I love the Roth option. I converted a lot of my 401k after leaving the corporate world into Roth. I do a self-directed Roth, so I still continue to invest in real estate and oil and gas through Roth money. And so I would say that um, there's sort of two ways to look at it. One is just the average investor simply maybe creates a lot of wealth in their 401k if you stay with the company for a long time. And so that's just where your money is. If that's the case, then if you want to get a better investment, investing in real estate or other alternatives, using that 401k money is great. Whether it's converted to Roth or left in traditional 401k, either one, that's where your money is. You want a better investment, you can do that. That's available through self-directed IRAs and self-directed Roths. Real estate is fairly tax efficient on its own, so it's not a terrible way. Like investing not in a Roth isn't terrible either. So I think it really just comes down to where is your money. Is it in traditional 401k, or is it in a regular brokerage account or in cash? Do you have it liquid from a sale of business? You can invest pretty efficiently without a retirement wrapper, or you can do it in those if that's where your assets are. In terms of what's better, um, I mean, I love Roth. I think it's a really powerful vehicle. Like I said, it's pretty efficient already, real estate in general, but when it's completely tax free in a Roth, or mostly completely tax free, that's hard to beat over a long period of time.
Well, it's good to
It's a
know.
really powerful thing.
Yeah, well, maybe I have to reconsider my thoughts and put some more dollars there to appease the big man. So I guess I'll have to
Yeah,
do that. So I appreciate you, I guess, confirming his thoughts there. And maybe I am wrong on that one. With that said, let's get into what you're doing now with family offices. So
sure.
what does that look like? What is your new role? What got you so
Yeah,
captivated to, kind of hitch your wagons with, Aspen, of course. Be curious to hear that story there because I don't think we've really unpacked that yet. So obviously off air. So be curious to hear it on air.
yeah, yeah. So I'll share why I ultimately decided to join Aspen first, and that's that I had done a couple of deals with them. And I'd done a couple of deals with a number of different companies. And I was investing my own capital and, talking with people about what I'm doing. And I started joining real estate conferences and meeting more and more operators and finding opportunities that sounded interesting to me. But I just kept coming back to Aspen. It was just one of the firms that I just felt very comfortable with to begin with, and it's been a great experience. So some of the operators that I've invested with, not Aspen, um, it wasn't the same. It was just a very different experience. Um, in my experience, Aspen has very much they put their investors first, and they want to protect their investors, and they want their investors to keep coming back for a very long time, and they really do. They just look at investments differently, and they put themselves second, and they put the investor first, and I really appreciated that. It was just a wonderful experience, and I've been very, very happy investing with them. And so it started to become um, when I would look at anyone else's deal, it just was sort of like, is this significantly better than what I can get at Aspen? Like, I just felt comfortable there. And so if I wasn't finding something that was blowing it away, then I just felt myself not getting that excited about it and just saying, well, let's see what Aspen has. Like it just, I just felt really comfortable after doing a number of deals with them with my own cash. And so I just felt comfortable that if I'm referring my friends, my family, people that I really care about, I just knew they were going to get an experience similar to my experience. And so I could feel good with it. And so I was trying to figure out there was a number of groups I was talking to, but I kept kind of going back to them. And so that's ultimately why. That's what the kind of the why Aspen Funds. But I've been talking with them for I guess close to 2 years now, and it became apparent that I could probably provide valuable experience from my previous role of working with very wealthy families into helping them kind of grow their family office, um, I guess division we'll call it. And so they have a couple of family offices that they work with, wealthy families, larger check writers who have unique needs. It's they look at money in a very different way. They have much longer time horizons. They are not worried about necessarily the liquidity of getting their money back in a very short period of time. They want a deal that's going to be attractive for a very long period of time with an operator that they're very comfortable with. And so yeah, that's what I've started to help do is I'm sort of the liaison between these family offices with these long-term time horizons and really just understanding what their needs are. And we take a lot of time to get to know them. And because of that, we can add something that is special to them, that's unique to them, and we know who to call with what deal, and we know how we're going to structure the deal, that it's going to be a win for them, a win for us. And we just really want that very solid multi-decade relationship with some of these family offices. So that's my role. It's a pretty cool opportunity to meet with some very interesting people, some really significant wealth creators, and yeah, so that's been pretty fun.
Amazing. Steve, thank you so much for your time today. Where can people get a hold
Yeah,
of you if they want to learn more about Aspen Fund, if they know any family offices that could benefit from your services? Where are you? How can they reach out?
yeah. Well, the Aspen Funds website is aspenfunds.us, and if there's a family office, there's a family office link there that comes to me. Also, I'm pretty active on LinkedIn, so reach out to me there. Steve Woodruff, CFP, is the full name. And yeah, send me a message. Let me know that you saw me on Craig's podcast, and yeah, I'd love to connect and talk to people.
Awesome. Well, thank you so much for coming on the show. For the listeners who have been tuning in, thank you so much, and we'll see you next week. Peace.